I've been saying it for the last 12 months. Now is the time to start investing in real estate, investing in multifamily. You're hoping to sell out of these properties, but guess what? Over the last 12 months, buyers have been more discriminate. We literally redid the entire unit, brand new flooring. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to lesson, we are going to be discussing in 2025, is there the great apartment reset? Are C assets still worth it in this part of the market cycle? And that's an interesting, exciting, confusing question all at once. Now, to give some history, when Jake and I started back in 2011, market cycle was a little bit different. Everyone who was in the business was looking at older assets. Why were they doing that? It was basically a function of price. You were buying these assets for such high cap rates. There was such an ability to add value to these properties and to be able to push the value up. And then you were able to either refinance the property or to sell the property. And that worked really well. You know in life how things work really well until they don't? Well, that's what happened with C properties. We always joke around inside the Wheelbarrow Profits community. We say, hey, you're buying a 4 cap. That's a C property built in the 70s. That will become a foreclosure sooner or later. And in a lot of markets, it has. For instance, in Dallas, it was such a raging market back in 21 and 22, maybe early 23, where you had to bid high. You were buying these older assets, but at 4 caps, hoping that you were able to add value and flip it out. Now, the problem that I have with C properties, older properties, one of the problems that I have is that if you're going to be a long-term investor and hold these assets for the long term, you're buying something that's built in 1970, and you want to hold it till the year of 2030 or 2035, whatever, that asset's already 80 years old. You need to buy it at a good cost basis. You need to buy it at a good price. Now, why do I say that? Because if you're going to be holding it for the long term, you can't go out there and put the proverbial lipstick on a pig and just make it look good, put a little bit of Band-Aid. No, an asset built in the 1970s or older may and probably does have cast iron plumbing. You're probably gonna have to do a lot of work on the plumbing. It probably has driveways that are an issue. I remember going into one of our properties that we bought, and it was an older property. You walk into the parking lot, there are potholes that are like 2 feet deep. It looked like Chernobyl. As I joke around, it was a nightmare. It was a mess. The roofs were terrible. The siding needed work. A lot of the units were down. But if I'm buying this property at an elevated price and I do my budgeting and the numbers are really tight, should I really do all that work? We call it ROE, return on effort. Should you do all that work just to get a little bit of squeeze out of that property? Now, back in the day when Jake and I were buying these assets at $30,000 a unit, and now they're going for $110,000 or $120,000 a unit, it is absolutely worth the squeeze, because we were able to buy them at such a good cost basis. We were able to actually put the amount of CapEx that was needed to refurbish and to replenish these properties. That property that I had just talked about with the driveways. One thing that we noticed when we bought that property, I think the property is already 6 years ago we bought that property. When we went in, we literally redid the entire unit. Brand new flooring, cabinets, countertops, new fixtures, new bathrooms, sanded down the walls. The unit was, in effect, a pretty brand new unit. Now, when you go back and you turn the unit again, you didn't need all that CapEx, but we needed to buy it at the right price. I think we paid like $40,000 a door for this property. It was coming off a USDA loan. It had a lot of deferred maintenance. It had a lot of work, but we knew at $40,000 a unit, where average rents in that market were around $800. We knew there was a lot of meat on the bone. We were able to buy that at 40, probably put 20,000 a unit into it. It's at 60,000 now, and now the property's more than doubled. So that's the idea, the mantra of getting into these high value add properties. And when you're first starting out in real estate, you're going to gravitate more or less to that kind of asset because they're quote unquote cheaper. They're more affordable. But the reason why they're more affordable is because there's a lot of value onto it, but there's a lot of risk as well. And you need to know when to time the market to be buying these types of C assets. Now, if you're newer to the business, you're buying them in the last couple of years, hoping that you can do that. That reno to refi or reno to fix. Well, you can't refi these properties right now because rates are really high. You're hoping to sell out of these properties, but guess what? Over the last 12 months, buyers have been more discriminate. And it's not only the buyer's fault that they don't want to overpay for these assets. It's the banks, the lenders that are pulling back on these C assets because they're saying to themselves, wow, you're buying this old asset. Handrails, are they at 36 inches? HVAC units, how old are they? Roof, does it need to be repaired? Is there aluminum wiring? Cast iron? What kind of circuit breakers? They are really scrutinizing these properties. And when you look at it, if you're experienced, you know how much this is all going to cost. Does it make sense to do all the work? And then what is the strategy? If you're able to buy them right now at a 6% interest rate, and you're able to buy them at an 8 cap, well, that's what we call positive leverage. It's really interesting because this week, Jake and I just interviewed a gentleman who's doing strip malls in secondary and tertiary markets. He kept throwing out this word, positive leverage, positive leverage. And I'm like, okay. He said he was buying these strip malls at 12 to 15 caps and using, 7% debt. He's getting 8 points of positive leverage. He was thrilled about it. And he's like, in the multifamily space, you're not able to do that. And it's really challenging. And that's what's been happening. You're looking at these properties that are at 4 caps, the debt's 6 cap. You're negative leveraged. When we come back from the break, I am going to share with you what we've been doing over the last couple of years when we've been looking at these properties. Now, you want to get into this business. It's really important to get into the business and to do it the right way. This episode here, I've been talking about buying C properties, and my good friend Vince Gethings is sponsoring this episode and the Wheelbarrow Profits community. With over 86,000 units closed and $5 billion in student deal volume, the results are incredible. To me, it's the premier multifamily community online, anywhere you can find it. At the heart of it is a proven 3-step framework: buy right, manage right, and finance right. It's a simple process that's helped thousands of investors buy cash flowing assets and achieve financial freedom. To date, over 150 members in Wheelbarrow Profits have left their W-2 jobs. You're gonna get hands-on training, live events, and a community that feels like family, all designed to help you close your first multifamily deal in 12 months guaranteed. Now, if you're serious about jumping in the multifamily and taking action, go to wheelbarrowprofits.com. That's wheelbarrowprofits.com and schedule your call today. What's really cool about the community, and especially this time right now, I've been saying it for the last 12 months. Now is the time to start investing in real estate, investing in multifamily. The last couple of years, it's been difficult to get deals. If you've been doing it, you've been doing your market research. But if you're serious now, the next 12 to 24 months, as rates drop, as things start to stabilize a little more, pricing is still going to continue to drop. We have trillions of dollars of commercial debt coming due right now in the next year. There's going to be so many opportunities where people overbought over the last couple of years. They didn't know how to buy right. They didn't know how to finance right. And they obviously, most of them did not know how to manage right. But let's get back to what we're talking about here, the C properties. When they're buying, they weren't buying with really, I would say, good criteria. And I can throw in the 3 pillars of real estate. Just Google 3 pillars of real estate. I've talked about it in a couple of other how-to podcasts. It's really a function of the market cycle. The 3 pillars are market cycle, debt, and exit strategy. Understanding your exit strategy will make more sense to what I'm talking about right now. If you're buying these assets now in this part of the market cycle and looking to flip out in the next couple of years, you're going to get burned. Knowing where you are in the market cycle is going to make you understand, well, should I buy these C properties? And as I'm speaking right now, in some of these markets, these properties are dropping in price. It's just that the sellers, they can't sell for these prices or the prices that they're really worth. I'm speaking to a lot of community members, and a lot of them are saying, I'm not even looking at a 1970s asset if it's at least an 8 cap on actuals. Now, if we go back to a couple of years ago and you said that to a broker, they would have thought you were nuts. but that's where you are. Be very careful. Don't overpay on these C properties because you don't have to. And those word actuals, no pro forma here. I don't know and want to care what the pro forma is. You're buying, you're buying on your pro forma, but you're borrowing on actuals. Let that sink in for a second. You're buying on your pro forma. And I think you're also buying on what the actual numbers are as well. But you're borrowing. You need a 1.25 debt coverage ratio on the asset. That's what's pretty cool right now. And a lot of these assets right now, their income is up, but their expenses are up. So look out and be careful when you're buying these deals, because I want you to buy them on actuals. And every market is different. But I know in Dallas, once again, because I've got a lot of students, a lot of members in the Dallas market, assets that were trading for 150, 160 a door in Dallas that were C properties, they're down into the hundreds in good markets, in good areas. Now, why is that? It's a function of the market cycle. Once again, we have so much supply coming on. Absorption's not happening. Rents are dropping. That market's got a 90% occupancy rate. So you're talking about a lot of assets that aren't being fully maximized. You're looking at usually when you're around 95%, you're looking at 5% right there that's not being rented. That's huge to the bottom line. And there's a lot less demand. There's a lot less people coming to the table with capital to be able to raise for these deals. That's dropping, and it's a function of supply and demand. Yield on cost. It's also called return on cost. I'm going to read the definition. Is a metric used in real estate to evaluate how much income a property is expected to generate relative to the total cost of development or acquisition. Now, what does that mean? When you look at it, that formula, you're taking, and what I would do is I would take what I think the stabilized net operating income is. Because when you're buying a property, a C property, an older property, let's say NOI is actual $100,000. What do you think NOI can get to? Once again, this is your pro forma, be conservative. If you think it can get to $150,000, great, that's your NOI. Divide it by the purchase price. You're buying this property for $1 million. And any costs associated with it. So total costs, CapEx, closing. So if you're into this property for $1.2 million total, you're going to take the stabilized and divide it by the total cost of the property. Now, if you're in a 4 cap market and you buy this property for a 4 cap, that's what you're buying it at. And all of a sudden it's stabilized and you get the actual cap rate after stabilization. And you brought that property all the way up to an A cap and the market is 4, should you do the deal? Great question. Is there enough meat on the bone for you to do the deal? For me, it looks like a really good deal. I've stabilized it. I've increased the NOI a lot. I've increased it and I've added a tremendous amount of value. And it's really a pro forma based number, thinking where I can find out value. Because a lot of times operations really aren't great. You can go in there and figure out what the operations look like and not have to spend a ton of money, especially in this part of the market cycle. One thing I should add, the strategy in this part of the market cycle is not to go in and add $10,000 or $15,000 per door and try to get rents up by $150 or $200. Over the last 12 months, we've been able to increase rents in our market without doing all that work. It worked 3 or 4 years ago. That was that part of the market cycle. Now it's not part of the market cycle now. There's more of a demand for customer service. There's more of a demand for touch points. So if you're going in thinking that you're going to spend all this money just to get that increase in rents, no. There's other ways, there's other efficiencies that you can bring in and work with the expenses of the property. Try to increase income, lower expenses, fill those vacancies, add in some additional income, whether it's, all the different fees. We're doing non-refundable move-in fees. That helps really well. And you're looking at it from that perspective. You're buying that property and you can really get that property from, let's say, like I said, once again, a 4 cap to an 8 cap. Do you do the deal? I would do that deal. Now, if you're buying it at a 4 and you can squeak it out and do a 5 cap, should you do the deal? I'm not really sure. It depends, because let's say you're buying this property that's stabilized and has $100,000 net operating income, but you can get it to 130. You've increased net operating income by 30%. But let's say the purchase was X amount, 1 million, but you had to put $500,000 to do that. Then all of a sudden the cap rate only increased a little bit. Is it worth all of that work? So once again, stabilized net operating income divided by the purchase price plus CapEx. That's what we are using right now. That's what you're looking for. And once again, I'm going to mention that word positive leverage. Just be careful of buying these low cap properties in a market right now that interest rates are at 6.5%. Don't buy them on the whim of saying, yeah, I can buy this low cap property and I'm waiting for interest rates to drop so I can refinance. That's a recipe for disaster. You don't know if, you know when they're going to drop, but if you know that you have the team and you have the business plan and you have the ethic to be able to get that property from a 4 to an 8, looking at the yield on cost, you do the deal. Now, as I'm going through this, if you have any questions down below in the comment section, ask me a question. Let me know what you think. Are you buying deals on yield on cost? What are you seeing in the market right now? Are you buying C properties? Now, once again, this is not a blanket statement to kill C properties. What it is, though, is if I'm going to buy a C property at a 4.5 or a 5 cap, and I can buy a B property a point lower, let's say a 4, I think right now in this part of the market cycle, I'm probably going to go with the newer asset. The newer asset's going to have less risk. It's going to have less work. It's probably going to be in a better part of town, higher median income, newer asset. And when you're looking at it from that perspective, I'm probably going to go for the B. But if you can buy that C property for a really good price and you've done it before and you know what the exit looks like, coupling it with the debt, go ahead, baby. Buy that C property and get to work. I want to thank you for spending part of your day with me here. I know how important and valuable and precious your time is. Just want to thank you for spending part of the time with me here today. If you want more information, go to jakeandgino.com, like and subscribe to the channel, and I will see you on next week's How To. Thanks, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.